SentinelOne is an interesting cybersecurity stock that's growing across all its key financial metrics. In this video, I'll answer if SentinelOne stock is a buy, hold, or a sell, looking at the company's revenue growth, its cash flow from operations, operating profit margin, return on invested capital, looking at its latest quarterly financial highlights, and looking at the prospects over the next 5 years, and finally comparing all of that against the company's valuation to determine if the stock is an excellent buy for long-term investors. Now, there's a lot to cover, so let's get into the details after this brief message for my sponsor.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Starting with the latest highlights for the company's second quarter fiscal year 2025. Now, I know what you're saying, is that a typo? Fiscal year 2025, we're still in 2024. The answer is no. Companies are allowed to have fiscal years that are different from the calendar year, and SentinelOne is one of those companies that does have a fiscal year different from the calendar year. Looking at the company's revenue, it grew 33% to $199 million in the latest quarter. Customers with average annual spending over $100,000 increased by 24% to 1,233. The company's operating profit margin improved while it's still negative to 40% negative compared to 67% negative in the same quarter last year. Operating cash flow turned positive, which is a huge inflection point, 1% positive compared to negative 8% in the same quarter last year. And the company's balance sheet remains healthy with $1.1 billion of cash and cash equivalents as of July 31st, 2024. Now looking back longer term, SentinelOne stock price is down 69% off its high 3 years ago in December of 2021. SentinelOne has demonstrated excellent revenue growth in recent years, $723 million in trailing 12-month revenue. That's up from around $150 million in 2021. Of course, cybersecurity is becoming increasingly important. It's becoming a must-have instead of a nice-to-have, and this industry is likely to grow for another decade or two, or more than that, because more of our lives are moving digitally, and the more that happens, the more the need for cybersecurity increases. And so this is an overall market that will continue growing for decades, and it will continue providing these companies with a tailwind as enterprises and institutions spend more and more on this critical element. Now, the cash flow from operations to sales metric has been increasing for SentinelOne. The actual number at 2.2% is not great. It's really low. But what's impressive is the trend improvement. I often say I don't mind companies with negative or even small cash flow from operations to sales metrics, as long as I see growth, improvement, and the company is still growing revenue, which is what I see with SentinelOne. Revenue is growing and it's improving its cash flow from operations up to 2.2%, where it was over negative 75-80% a few years ago. So the company is using its revenue growth to add to incremental cash flow and profitability, and that's a great sign for SentinelOne stock investors. Now, the last time I updated SentinelOne stock was on May 31st, and I rated the stock as a hold on May 31st, given these metrics that I saw a few months ago. Moving on, you can see the company improving its operating profit margin as well as its return on invested capital. The trend lines are upward, but the numbers are negative. 44% negative for return on invested capital and 17.6% negative for operating profit margin. But again, like I said, for the cash flow from operations to sales, I don't mind when companies have these negative numbers as long as they're demonstrating improvement, and improvement at a reasonable scale, which I do see with SentinelOne. The improvement, especially on return on invested capital, is happening rather quickly. Looking ahead over the next 5 years, the analysts on Wall Street that are following SentinelOne stock, they think it's going to grow its earnings per share at 40% per year over the next 5 years. Now, that's a strong rate of earnings growth. That would be roughly 4 times the average stock in the S&P 500. And it's reasonable to assume that SentinelOne can achieve this metric, because if you look at the performance over the last couple of years and you look at the performance in the most recent quarter, the company is demonstrating excellent improvement on revenue and margin improvement. So if those trends continue, which it's reasonable to assume they will given the industry tailwinds and given its competitive position, the company's growth of 40% in earnings per share over the next 5 years is a reasonable assumption to make by these Wall Street analysts that are following SentinelOne stock. Finally, I wanted to look at the company's valuation, and SentinelOne stock is trading at a very expensive valuation, a forward price to earnings of 114 for SentinelOne, and that's up considerably in the last few months. It was trading as low as a forward price to earnings of around 80 around June of this year, and that's now shot up higher to 113. Now, there are cases where I would be willing to pay a forward price to earnings of 113 or 114, but this isn't one of them. SentinelOne, while it's making excellent improvements across all its key categories, including revenue, customer growth, average revenue per customer, profitability, return on invested capital, across the board, it's making improvements on all its key characteristics. That being said, some of those characteristics are still negative, like its operating profit margin, like its return on invested capital. Cash flow from operations is barely positive. And so even though the trends are moving upward, the actual numbers are not that great. And if I'm looking at a forward price to earnings valuation of 114, I would want everything to be excellent and moving in an upward trajectory. That's how expensive a valuation of 114 is. Everything needs to be great in order to justify for me to be willing to pay this kind of valuation. And you can understand why a few months ago when I evaluated SentinelOne stock, I had it rated as a hold. The company itself, the metrics, everything, all of that is moving in an excellent direction. However, all of its excellent prospects appear to be incorporated in the price already. So it's already incorporated into the price that the company is going to grow its earnings per share by 40% each year over the next 5 years, and that the industry will continue growing for decades. So all that being said, I think the stock is too expensive, even though it's an excellent company. I think the stock price is trading a little too expensively. In fact, a lot more expensive than I would be willing to pay for SentinelOne stock. The forward price to earnings ratio would have to be way lower, at least in the 70s, probably even below that in the 60s, for me to consider rating SentinelOne stock as a buy with its current financial metrics and financial trajectory. So to answer the question, I still think the stock is a hold, and I'm updating that recommendation on October 1st. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.